the last year has seen some of the biggest growth in home prices in American history, which is really news to no one. And for people who are already in the housing market, maybe you own your primary residence or you're an active investor, this has been really good news. You've built up a ton of equity and built a lot of wealth. But for the people who are trying to get into the housing market right now, maybe you want to expand your portfolio or buy your first investment, or you're just looking for your primary residence, you want to know if this crazy price appreciation is going to continue. Or maybe in 2022, are things going to start to cool down, or are they even going to reverse and prices might start to sink? And this is a really big question, and a lot of the big companies and economists are starting to weigh in on their projections for 2022. So today I am going to review these projections and let you know what I think is going to happen in the housing market in 2022. Now, most of the big companies don't think housing prices are really going to slow down all that much. Goldman Sachs, which is a huge financial institution, just said that they think the housing market is going to grow 16% in 2022. Zillow, not as excited. They think 12%, which is still huge. And Fannie Mae came in just over 7%, which in almost any other year would be a huge year for housing market gains. But given where we are right now, that actually seems relatively modest. It's not actually modest. These are all really big gains in the housing market and could mean huge returns for real estate investors. So the question is, are these predictions actually realistic? What factors are these companies basing these bold predictions off of, and what risks exist for home buyers and investors in 2022 that maybe didn't exist in 2021. Today, we're going to look at all this. We're going to look into the primary factors that are driving the housing market in 2021, and we're going to look at all of those factors and what might change with them in 2022. This is going to be a really fun video. I've had a really good time pulling together all the data and information, and I think you're going to want to stick around to see all of this because, after all, the big question for every real estate investor right now is what will happen to the housing market in 2022. Hey, what's up, everyone? I'm Dave Meyer, the data guy here at BiggerPockets. I'm also a real estate investor and the very hungry, data-obsessed guy behind the Instagram account, The Data Deli. And today I am going to talk about one of my favorite topics, the state of the housing market and what could happen in the coming years. Now, I've gone on record many times on the show, if you watch the show regularly, at saying that the housing market was not going to crash in 2021, despite what a lot of people, especially here on YouTube, have been saying. And we still got a few months to go, so I'm not going to take a victory lap yet, but the data I used to make these conclusions and predictions has not changed. And as a result, I still find it very hard to believe a crash is coming in the next few months. But what about next year? What is going to happen in 2022? To be honest, I think there are some more risks for the housing market in 2022 than there were in 2021. So in this video, I'm going to walk you through the major factors impacting the housing market, which I think are demand, supply, interest rates, and affordability / foreclosures. I'm just going to group those together for the purposes of this video. So if you've been watching my videos recently, or really just last week, only one time, last week I started using this whiteboard, a digital whiteboard, and I think it worked really well. People seem to like it. I think it helped explain some complicated topics. So I'm going to do that again. And I'm going to go through those four factors: demand, supply, interest rates, affordability. Just a quick briefer on supply and demand. When demand goes up, prices tend to go up because there are more people who want to buy something. When supply goes down and there's less of something to buy, prices also tend to go up in those situations. When those two things happen together, when demand is high and supply is low, that is the perfect storm for price appreciation. That is exactly what we've been seeing in the housing market. So that's just a reminder of where we're at. And I want to talk about demand and why demand has been high and is going to stay high, in my opinion, over the next couple of years. Demand is basically how many people want to buy a house. And all sorts of people want to buy a house. There's investors, there's first-time home buyers. But the biggest thing that is fueling demand in my mind right now is that millennials, which are now the biggest generation in the United States, are reaching their peak home buying age. They're all about 30, or the biggest group of them. And this is represented on this chart here from the US Census. And what you can see from these two bulges right here that I'm circling are these huge spikes in population right now. It is people who are about 30 years old right now, and that is the peak age when people want to start buying homes. So we have a lot of people, the biggest generation in the US, are reaching the age where they want to buy homes, and that is what's fueling strong fundamental demand in the housing market. And that is likely to continue for at least the next 3 or 4 years because there's this big tail over here as well. People are not yet 30, but there's still a huge population glut over the next couple of years of people who are very likely to want to get into the housing market. Now, that is what I believe has been fueling strong fundamental demand for a while and is likely to over the next couple of years. But what a lot of people have asked me recently is, what about COVID? Like, did that spike demand? And the answer is yes, it did. If you look at this chart to the right, which comes from investing.com, but is actually data from the Mortgage Bankers Association, you can see that we've been on sort of this trajectory of slightly increasing demand for the last 5 years or so. And that is a good thing. And that is a function of what I was just talking about, of demographics. More people, these big groups of population want to get into the housing market and demand goes up. Now, during COVID, everything sort of changed for a while where we were seeing these crazy spikes in demand, which you can see right here. So things really did go nuts for a while. But what I find quite encouraging for the foundation and the stability of the housing market is that demand has returned to a level of about where we would expect it. Like if you continue this trajectory that we've been on for the last 5 years through where we are today, we're about where we would expect to be. And so that's really great. So we did see the spike in demand, and that certainly helped contribute to appreciation over the last year or so. But we have returned back to a normal level of demand, and housing prices are still going up. So to me, that means we are sort of past the COVID era of demand, and we are now back to population and fundamentals of demand that are driving demand for the next couple of years. And so I don't think we're seeing this huge spike that is unsustainable. Instead, I think we are going to see demand stay relatively stable and increase modestly over the next 2 or 3 years, which is a good sign for prices in the housing market. So that's demand, going to stay stable, probably grow modestly, which is a positive thing for appreciation. Next, we have inventory. And so inventory is this thing that is really on top of mind for a lot of people because it has been so low during the pandemic. There basically haven't been a lot of homes on the market. And I could have put a chart in here. I probably should have, but I didn't. So what I will just tell you is that it is estimated that the US is 4 to 5 million homes short of demonstrated demand. So there's a certain amount of people, certain amount of families and households that need shelter and housing in the United States. And the US is 4 to 5 million homes short of demand. And so that to me says that inventory and supply is going to remain low for a really long time. And I want to quickly explain why inventory is so low and why we are so short of demand, because it helps explain some of the fundamentals of the housing market that are useful and pertinent to this conversation. So going back to the early 90s, you could see that housing building, this chart shows the number of new homes being constructed. They call it housing starts. So there's a number of new housing starts. And so you could see we were on this very aggressive trajectory that went through to the recession and then tanked. And what was happening is that builders, because people were buying speculatively, they were building more and more and more because they were making amazing profits. So they just continued to build. Then when the bottom fell out of the market, this is a crazy line. Look at how dramatic that fall in the number of housing starts is. When no one was there to buy homes anymore, builders just stopped building. They weren't building new homes anymore. And what happened was a lot of these people, a lot of construction companies, people were building new homes, either went into another line of work or their business went out. So they didn't really pick up building again for quite a long time. If you look at where we are today, which is a long cry from where we were in 2018. So if you look at this line here, we're about at the level of home building that we are at in 2006. So we are not at a level where we are reaching speculative building. In fact, at this level of building, if we continue on the trajectory we're on right now, it will take 9 to 10 years for us to close the demand gap. These 4 to 5 million homes that we are short in the US, it will take 4 to 5 years for us to close that gap at current pace of construction. Now, construction could accelerate. I personally think that's a bit unlikely, but it could accelerate a little bit, but then it might be 8 years till we close the gap. So to me, inventory, the amount of supply we have in the market, is going to remain low for the next 8 to 10 years at a minimum. And so to me, again, another positive sign for the housing market in 2022. The next thing I want to talk about is interest rates. Now, interest rates are lower than they've ever been. Just look at this chart. This looks back to about 1968, I think, 67. And basically since the early 80s, we've been on this downward trajectory for interest rates, and we're basically at the floor. I mean, you can't really get much lower than that. In fact, based on the way mortgage rates are set, which is a combination of the Fed's rate and 10-year Treasury, basically are the two things that you look at to predict mortgage rates. Those are both so low, basically at historic lows, that I think it's unlikely that mortgage rates will ever go lower than they are right now. And you can see we've been on this trend for a long time. And this really matters a lot to housing prices because interest rates play a huge part in housing affordability, right? So the cheaper interest rates are, the more home you can afford. I actually did this analysis recently where I looked at buying a home for $350,000 at a 5% interest rate. And I looked at if rates dropped to 3%, from 5% to 3%, how much more home could I afford? How much more could I buy and have my monthly payments on my mortgage stay the same? And the answer was about $100,000. So I could pay the same amount for $450,000 per month that with a mortgage at 3% than I would be paying for a $350,000 home at 5%. So that just shows you that when mortgage rates drop as far as they have right now, that it is going to allow people to buy more and more expensive homes. And yeah, of course, you're going to have to put more down on a more expensive home, but your monthly payment would stay relatively the same. Now, I'm moving over to this chart, which is basically the same data, it's just zoomed in only for the last 5 years, because I want to show you that interest rates are starting to inch back up a little bit. And this is really important because when interest rates rise, it does tend to cool the housing market. Now, I want to be clear. I'm not saying this will crash or tank the housing market. It starts to cool the housing market. But I've been following some really prominent economists who know much more about the relationship between housing and mortgage rates than I do. And what several respected economists say is that the housing market will start to see a decline in demand and therefore some lowering of prices, or at least cooling of prices, at around 3.75 to 4% interest rates. So we're talking about this area right here. Now, Fannie Mae and other people who predict interest rates are saying that in 2022, we are expected to only get to about 3.3 to 3.5% interest rates. And that's because the federal government, who has a lot to say about the mortgage rates in the United States, said they aren't going to raise interest rates until Q4 of 2022. So Q4 2022. So about a year from now would be the first time the government would consider raising rates. And they're only considering raising it 0.25%. So that would probably inch up interest rates, but not to the point where it's going to affect demand or the housing market. So that is something I really want to keep a close eye on, because if interest rates do rise faster than this, if for some reason they go up to 3.5, 4, 5, 4 over 4%, I do think it could have create a situation where housing prices go flat or maybe even slightly negative. Again, I don't think tank, but I do think it could really cool off the housing market significantly. And the main reason that would happen, honestly, is just inflation. Inflation is higher than anyone really wants it to be, about 5%. And the main way the government fights inflation is by raising interest rates. So they've said they're not going to raise rates for about a year, but if inflation is higher than expected, that could happen. That's something I think of as a risk for the housing market in 2022. Now, the last area I want to talk about is just something that honestly I don't think is necessarily like a fundamental of the housing market, but it's something I get a lot of questions about, so I'm going to address it quickly here. Basically, at the beginning of the pandemic, a lot of homeowners chose to go into forbearance, which is basically a temporary delay on paying their mortgage while they figure out their financial situation. And as you can see, at the beginning of the pandemic, about 5 million households went to that, got into that program. People thought when these come due, when people have to start paying their mortgages again, the market's going to tank because we're going to see all these foreclosures. It's going to put a huge glut of supply on the market. Long story short, that just didn't happen. Instead of any of that happening, we've seen this long, steady decline in the number of homes in forbearance, which is exactly what the program was designed to do. It is working extremely well. About 85 to 90% of homes that are coming out of forbearance are in good standing with their lenders. And so basically, it's a non-event. All of these people are starting to pay their mortgages again. They still owe the same amount. They just usually tack on more payments to the end. But we are down to regular levels of forbearance and foreclosures in the US. And so this is just not a factor. And I know a lot of people on YouTube have been saying that this is going to cause a crash in the market. That's just not true. I also want to say another thing about this perceived crash. And I want to be clear, I do think there are risks in the housing market right now. And that is a risk that prices will flatten out or even decline a bit, but not a crash. And I think this drama about things going down 20 or 30% is really overblown. One, because of this forbearance thing, but I also want to show you about the credit quality of mortgages that are going on right now. You've probably heard the Great Recession and the often referred to as the subprime mortgage crisis. And that's because mortgages were being originated in that time that were given to people who weren't in a good position to repay those loans. And you can see that on this chart that I'm highlighting here. And this shows mortgage originations by credit score. And you can see in the early 2000s, right here is when the biggest amount of mortgages were originated to people who had the lowest credit score. Look at that. So credit score under 620. There is a large amount of mortgages back then that were being originated. Since then, that just doesn't really exist. Do you see any dark blue down here at all? I mean, there's barely anything down here. So the lowest credit scores are not getting mortgages anymore. Instead, look what's happening. Look where all of the mortgages that have come since the pandemic are. There are people with 760 plus credit scores. Those are incredibly good credit scores. This means the people who are fueling up or who are sending the housing market upward are all in a very good position to pay their mortgages. And I know credit score isn't everything, but it does matter that these people are in a good position to pay back because it means there is less risk of a foreclosure crisis coming in the US. Now, I did loop together foreclosures and affordability, and I don't have a chart for affordability here, but I do want to talk about it quickly because I personally see affordability as a big risk to the housing market. Basically, I think the biggest risk is not foreclosures or supply or anything like that. I think it could grow too quickly. If the housing market stays at the appreciation rates that we have seen over the last 2 years, it is likely to reduce demand because ultimately it's going to reach a point where people just can't afford to get into the housing market and they're going to just choose to rent. And that could reduce demand, which could bring down prices. So I just want to mention that affordability is a huge problem in the US. And the best thing in my mind that can happen in 2022 is return to a level of growth that is more sustainable and more normal. Now, normal is somewhere between 2, 5, 6% per year in appreciation. I don't personally think that's where we're going to get to, but I think we're going to get a lot closer to that next year. So hopefully we won't see any declines in that housing market. So the last thing I want to do before I leave is just show you all these indicators that we have for 2022. And I want to show you along this continuum that I have here, where I think they fall in terms of, are they going to help prices or hurt prices? So first, I'm going to find demand because we talked about demand a bit earlier, and I'm going to put that as slightly positive. So demand is high and it's stable. So I don't think it's going to start pushing prices much higher. But as we've seen because of the demographics, it is likely that demand will go up slightly over the next year. And so I think that's going to be a modest push towards higher prices. Next, I'm going to look at supply. And I actually think that is going to be even more helpful to prices next year because I just don't see enough houses coming on the market where it's going to push prices down. I think there's going to be a lot of demand. Demand's going to stay stable. There's not going to be a huge glut of supply. And I think the lack of houses in the United States, this housing shortage, is going to keep pushing prices higher. It's going to continuously put upward pressure on pricing for the next couple of years. The next one I'll look at is interest rates. And I'm going to put that as just about neutral because I do think there's risk, but based on the forecast that I respect, I don't think it's going to reach a level where it hurts demand. But I do think that there is risk here. So I'm going to put interest rates as neutral. Next, I'm going to look at affordability, and I'm going to put that as putting downward pressure on prices because I think affordability is a big problem. We have this concerning issue in the US where we might be pricing most people out of the housing market, which could lower demand. So I'm going to put that towards lower prices. And then one more thing I wanted to add, inflation. We haven't really talked about it much today, but inflation generally sends the price of everything up. So if anything is going to help contribute to higher prices, inflation's certainly going to be up there. So I'm going to put inflation over here as well. And so I should have put a little line here. I'll just draw it right now. I'm going to put, neutrality around, erase that. I'm going to put neutrality around here. So I think that overall, things are tending towards higher prices. And I should mention that I left foreclosures up here because I just don't think it's a thing. I don't think it's going to impact the housing market positively or negatively. I guess I could put it neutral, but I'm not even going to put it on there because I think we're just at equilibrium with foreclosures right now. And it's not going to make a big difference in the 2022 housing market. So overall, I see housing prices continuing to go up next year. I think Fannie Mae and Zillow are probably the closest. And again, I don't build my own economics to predict exactly what numbers we're going to see next year. I would love to do that one day, but I don't have time to do that. So I'm really just reacting to their own, their projections and my own feelings about the housing market. And what I keep thinking is that we're going to see price appreciation next year somewhere between 7 and 11%. I know that's kind of a broad range, but there's so many factors in the housing market right now that it's hard to nail down. But that's about what I see. I think that we are going to see a big decline because right now we saw 20% year over year marks. We're now at about 16%. I think that's going to about halve. I think 8-9% could be realistic for next year. And I hope it does come down. Ideally, even we could see 4 to 6%. That would be even better in my opinion, because I think it would create a more sustainable housing market. And I say that because, of course, I'm an investor. I want to see my properties go up. But I think if they go up too quickly, it does risk a correction. And I would rather just see more modest, almost boring growth over the next couple of years, because I think that will be more sustainable and generate better returns and a better quality of life for everyone in the United States. So that is my hope. Hopefully this video has been helpful to you guys. I really like explaining the housing market and everything that's going on in it. So please let me know in the comments below if this video is helpful to you. I'd also love to hear what you think is going to happen in the housing market in 2022. For BiggerPockets, my name is Dave Meyer. You can always find me there on BiggerPockets or at The Data Deli on Instagram. And I will see you guys all next week. Thank you so much for watching.